Assalamu alaikum. This is lecture 25 of Advanced Cost and Management Accounting. We are discussing the topic of transfer pricing and the policies that companies should have with regard to transfer pricing. We have seen that transfer pricing has several purposes. One is to transfer the cost from one company to the other. Then there is the question of performance of the individual divisions. More or less, when you have an organization where one part is being produced in one division and that is being sold to another division, and that part is incorporated in the final product. So you have the intermediate product and you have the final product. And when that exists and the final product is being sold to the market, you need a system of transfer pricing. Transfer pricing, we said, is going to have impact on profitability because these are two individual entities. It is considered advantageous and it is considered important to allow a certain degree of autonomy, independence to each of the divisions, so that they must be responsible for the results which they are producing and for the profits which they are making. Transfer pricing can therefore affect the performance of the division because it will affect the revenue of one, which is the supplying division, and it will affect the cost of the other, which is the receiving division. Therefore, in assessing the performance, the policy of transfer pricing will have to be kept in mind because it will have an impact. Now, we have looked at various different sorts and various different methods of transfer pricing. We looked at marginal cost, we looked at market price, we looked at full cost, we looked at full cost plus markup. And so there are various ways in which transfer pricing can be set. We have seen that there is sometimes a conflict in purpose when you use the same transfer price for several different purposes, like that of performance measurement. Ultimately, then, we should try to arrive at some kind of recommendations to see what would be the recommended and the optimal method of transfer pricing that is going to impact companies and the companies should prefer. We have said that there are different settings in which transfer pricing is used. One setting could be a domestic setting, two divisions, and one supplying to the other. Another setting could be an international setting, where companies are producing the intermediate product in one country and are selling it and producing the final product in a different country. Now, among other things, this kind of a situation will have impact on taxation, which the whole company is going to have to suffer. For example, there might be a different tax rate in one country where it is producing, and there might be a different taxation rate in another country where it is producing the final product and selling. In practice, we have seen very often the global impact of taxation is regarded as probably the important aspect in transfer pricing, so that the mechanism to minimize the global impact of taxation will take precedence over the other functions of transfer pricing. We will see this in an example, but where taxation rates are low, companies will try to have profits located in that country and in those companies. And where taxation rates are high, companies will prefer to have low profits in those kind of countries. We are going to look at several recommendations. We'll start with the domestic setup. Let's look at the domestic recommendations. Slide 1. Domestic transfer pricing recommendations. Where a competitive market exists for the intermediate product, the market price less any adjustments to reflect additional selling and distribution expense should be used as the transfer price. So we've looked at a competitive market position where We said competition is strong. This means that there are a large number of producers and a large number of sellers, and no individual or group of sellers or buyers can have any significant influence on the market and on the prices. When situations and competition like this exists in the market, then we have said that the market price, less any adjustments to reflect the additional selling and distribution expenses. Now, when companies are selling to each other and from one division to the next, then the selling cost will be different or will be insignificant, and the packaging cost will also be insignificant, as the market desired packaging costs will not be incurred, and the channels for distribution and therefore selling costs, those will not be incurred. So we have said, therefore, an adjustment can be made to the market price. So you use the market price of that product, intermediate product, but you adjust the market price for the selling, distribution, and packaging cost. You make an adjustment to reduce that, and that price, we have said, should be used in a domestic market scenario where competition is strong. Competition is healthy, markets are competitive. If supplying division has spare capacity, the receiving division should be instructed to purchase the agreed quantities from the supplying division to ensure overall optimality. This is a condition where the division which is supplying the product, it has spare capacity. That means that it cannot sell all the product that it can produce. From a perspective of the entire company, therefore, it will be important to instruct the receiving or the buying company to buy its product from its own division or company. Even though the market has good competition, it has products available outside, but because there is spare capacity in the supplying division, from the company perspective, the buyer must buy from its own supplier. Within the company, you must first buy all that you can. Otherwise, there might be a chance that the supplying division will produce something which it cannot sell. So, company overall optimality is achieved when the receiving division is instructed to buy all the product from the supplying division. Number 2, where no external market exists for the intermediate product, transfers should be made at the long run marginal cost. The long run marginal cost should consist of two elements: a short run marginal cost per unit of product and a fixed lump sum fee based on budgeted use of average capacity of the supplying division. In a scenario where the intermediate product cannot be sold outside to other companies, here what should be the price of this product, intermediate product, being sold to a division within the company? And we have said here the recommended policy for the company would be to use the long run marginal cost. Marginal cost, as we know, is basically variable cost. It is very often it is used as similar to variable cost. But in the longer run, if we are only looking at variable cost, then the fixed costs are not being incorporated. And therefore, the supplying or the manufacturing division is going to show reported losses. It will not be able to break even or show any profits. So in that case, if we are using the long run marginal cost, we will use the variable cost, plus we can have one method would be to include a fixed lump sum fee to cover the fixed cost of the supplier, the supplying division, so that it is not left with losses and showing an inappropriate or unacceptable performance position for the division. So in order for this division to cover its lump sum fixed costs, then those costs are estimated and a lump sum fee is added to the variable cost. And that becomes the long run marginal cost. And that is recommended where there is no external market for the intermediate product. This is to ensure that the receiving division incorporates the full cost of the supplying division's resources. So by incorporating the lump sum fee of the fixed costs, you are at the same time ensuring that the receiving division is being charged for all the costs that have been incurred by the company, and therefore all the costs that have been incurred by the supplying division. If we were to only use marginal cost and equate that to variable cost, then the receiving division would be receiving product at a cost which doesn't even cover the full cost of the supplying division. So in this way, we have incorporated the full cost of the supplying division to the receiving division. The receiving division receives the product at a cost which reflects the full cost of the supplying division. Without this lump sum transfer, the receiving division would be getting product at a cost which does not cover full cost. So it would not reflect a fair consumption of cost and resources even in the receiving division. It would have an impact on profitability of the supplying division, but it would also be having an impact on the cost of the receiving division. Where an imperfect market for the intermediate product exists and a small number of transactions are involved, a negotiated transfer price system is likely to be most suitable. Some external benchmarking is likely to be used to enable a meaningful bargaining process to take place. Talking about the imperfect market situations. Imperfect market situations, remember, will be where certain suppliers or a group of suppliers or a group of customers are able to influence the market and the price. In these situations where price cannot be determined without the influence of these players, there we have discussed another method of setting transfer prices, and that was the method of negotiation. So the buying and the selling side will sit in front of each other and they will both come to an agreed price, a negotiated price, which is going to be used as the transfer price. We mentioned there are several advantages of using a negotiated price. One of them is that both will feel that they have the appropriate price that should be charged, but there are also at the same time several disadvantages. The disadvantages include the difficulty in arriving at a common price. There might be disputes and arguments over what would be the most appropriate and applicable price. In those situations, either some top management will need to be involved in the discussions, or some benchmarking will be used. Benchmarking is like using the price of similar products in similar situations. Market price of other available similar products, and you can adjust that for various known factors such as the selling and packing expense. So negotiation can be a method used for imperfect competition scenarios. Where cost-based transfer prices are used, standard costs and not actual costs per unit should be used. If actual costs are used, supplying division will be able to pass on the cost of any inefficiencies to the receiving division. This last point demonstrates the difficulties of arriving at one price. And we have said that where the cost is being used, then the cost used should be that which is the standard cost. If you use actual cost and there are inefficiencies, wastages of the supplying division, it will just get hidden. They will use that cost and transfer the entire cost to the buying division. So in order to bring in this factor of efficiency and the factor of wastage and eliminate the wastage, their standard cost should be used. A standard cost is something which is a preset cost divided into various components. The cost basically comprises the material, labor, and overhead. And so what would be a reasonable cost for material, labor, and overhead? That is established as a standard, and that should be used in the transfer pricing when using the cost as a basis. That standard cost will reflect that if there are any losses, wastages, inefficiencies of the supplying department, they will not get transferred to the buying department in the transfer price and in the GARB and the hidden transfer price, and all the transfer price will be treated as revenue for the supplier, and it will not reflect the inefficiencies and the wastages. Supplying and receiving divisions may be located in different countries with different taxation rates, and the taxation rates in one country may be much lower than the other country. It would be in the company's interest that most of the profits are located in a country with low taxation rates. This brings us to the international scenario. On the international scene, we are going to see that there would be a difference in taxation rates. Here, transfer pricing will have an impact, and difference in the taxation rates is going to be an important decision-making factor. Most companies would like to concentrate profits in low tax areas and to have very low profits in the high tax areas. As we said, transfer pricing is also a mechanism that can be used to locate profits. If you charge a high transfer price, then the supplier is going to have greater revenue, and the buyer and the receiving side is going to have greater cost. The greater revenue will provide more profits for the supplying side, and the greater cost is going to provide lesser profits in the buying side. Of course, this thing can be reversed if the need arises. So on the international scenario, companies would give a high importance and high priority to the taxation rates. They will determine the transfer pricing policy in the international scenario. For example, an organization manufactures products in a country A which has a marginal tax rate of 25% and sells those products in country B where marginal tax rate is 40%. Company will use highest possible transfer prices so that country B will have higher costs and lower profits. The opposite for country A. This example demonstrates what we have been saying, where if a country has a profit rate of 25% and the other country has a profit rate of 40%, then the company is going to try to concentrate its profits with the 25% tax rate instead of the 40% tax rate. And the way to do that would be to use the transfer pricing mechanism. It is going to, if the country A is supplying and has a low tax rate, then the company will try to have most of its profits in that country A. And that can be done by having a high transfer price. A high transfer price would reflect revenues for this company in this country, and it would reflect a higher cost in the other company and the other country. So the lower tax rates will encourage companies to have greater profits in that country. In many multinational organizations, the taxation issues outweigh other transfer prices issues, and the dominant consideration is the minimization of global taxes. Taxation authorities are aware that companies can use the transfer pricing system to manipulate the taxable profits. The arm's length principle is used. So that's how we are saying that multinational organizations which are going to operate in more than one country, for them, often taxation issue is going to outweigh the other issues in setting the transfer price. Their basic and priority aim would be to minimize the impact of global taxation. Worldwide taxation, they would want the company to have the profits where the taxation is lowest. Many countries, therefore, and the taxation authorities in countries have become aware that this transfer pricing is used as a mechanism to shift profits and perhaps to avoid taxation. So it is possible that the taxation authorities in one regime will disallow a transfer price as an appropriate price. And they will use the arm's length rule and the arm's length basis in deciding what the price should be. This means that the taxation authorities will try to prevent the manipulation of profits by use of transfer pricing. This is experienced in various industries, and transfer pricing issues arise in various countries, and the authorities are therefore at all times trying to establish prices which reflect and are nearer to market prices rather than artificial transfer prices in order to avoid taxation. The basis that we said that they are going to use is an arm's length transaction basis. An arm's length transaction basis implies that what would be the transaction if this company was not buying internally? In other words, the similar products, what is their market price? How are other companies buying? And the same company, if it's selling to other companies, what price is it using to sell to other companies? What price is it available in the home country? And so those kind of prices, etc., can be examined to see if there is some price manipulation. And there are laws and tax authorities which disallow transfer pricing on the basis where they are obviously different from an arm's length transaction basis. The arm's length principle is used, and this means similar transactions involving unrelated parties, or deduction of profit from selling price, or a cost plus method. So under the arm's length basis, three different methods are used. One is to see if there is a price for a similar product available. If a price can be found of a similar product being used in the market, the authorities might use that price. The second method is that from the transfer price, whatever profit has been kept by the company, that can be deducted. And so you arrive at a lower transfer price. And the third method is the cost plus method, to see what is the cost and perhaps a margin on top of that cost to arrive at a reasonable transfer price. So these are the methods that are used by the taxation authorities to try to overcome this manipulation factor in the transfer pricing system. Let us look at an example for two different divisions within a company and to examine this basis of transfer pricing a little further. X Limited, a manufacturing company, has two divisions, Division A and Division B. Division A produces one type of product, Xeno, which is transfers to Division B and also sells externally. Division B has been approached by another company which has offered to supply 2,500 units of Xeno for ₹35. The following details are available. Let's just look at the scenario before we look at the details. The scenario here is that there is one company and it has two divisions, Division A and Division B, and Division A is producing and selling to Division B. Now an outside supplier has come and offered Division B the same product, and they have offered this company that product at a price of ₹35 per unit, and it can supply 2,500 units at this price. Because Division B is buying from Division A, we are going to now see what would be the impact of buying from outside or from within the company. Sales revenue, sales to division B, this is from division A at rupees 40, is 400,000. So division A is selling to division B at a price of 40, and division A is selling externally at a price of rupees 45, and that is 270,000. Now, less the variable cost of this product to the company is rupees 22. So the variable cost total amounts to 352,000. Fixed costs are taken as 100,000, and this is showing a profit of 218,000. If division B decides to buy from the other company, what will be the impact of the profit of division A and on X Limited, assuming external sales of Zeno cannot be increased? So the outside company is prepared to sell to division B at a price of 35. Division A is selling to division B at a price of rupees 40, and it is selling to outside buyers at a price of rupees 45. Its own variable cost is rupees 22. So the variable cost to division A of producing this product is 22, and it is selling at 40 to B and outside for 45. Division B, if it decides to buy from outside at that price of 35, let us see what would be the impact on the profits of division A as well as profits of the entire company. The loss of contribution in division A from lost sales of 2,500 at the rate of rupees 18, which is the contribution, selling price is rupees 40 to division B, and its own variable cost is rupees 22. So at this contribution of 18 per unit, division A would be losing 45,000. The impact on the whole company is that external purchase cost is going to be 25,000 units at 35, which is 87,500, and incremental cost of manufacture, which would be the cost that the company would have incurred at 22, would be 55,000. So the company's additional cost would be 32,500. So this is the impact A on division A, and secondly on the entire company as a whole. This shows the impact that if division B buys from outside, then it is going to lose the contribution which itself division A was having. And that contribution was the price of 40, selling price of 40, less the variable cost of 22. So 18 rupees per unit will be lost by division A as a result of the purchase by division B from outside. It can't sell any more outside, so this production cannot be sold, and therefore it is going to lose the contribution from this product. So the impact would be that division A would lose a contribution of 45,000. For the company as a whole, if you look at what would be the cost of buying from outside, the cost would be 35 for the 2,500 units, and that amounts to 87,500. But at the same time, this cost is going to be 87,500 from outside, whereas the incremental cost of manufacture would have been 22. So when it produced itself, it had a variable cost of 22. But when it's buying from outside, it is buying at the price of 35. So there is a 13 rupees per unit incremental cost, additional cost to the company as a whole. And the total cost of this additional incremental amount would be 32,500. So this is how the pricing can impact, and the scenario of the company needs to be looked at. If you buy from outside, where your own sales cannot be sold outside, then the division would suffer their loss of contribution, and the company must compare the price from outside with its own incremental cost. If the division B was going to compare the price of 35 given by the outside supplier with the price of 40, which is given by division A, then it will not make a decision which is optimum for the company as a whole. Because as a company, the cost of producing the product is rupees, marginal cost is rupees 22. So therefore, in buying from outside and comparing the prices and looking at the transfer price, the company has to look at the marginal cost, and that is going to give the optimum decision. Effects of transfer pricing on divisions and company profits. We can look at another example, and this example will give greater detail of what can be the effect of transfer pricing on the profits of divisions and the profits of the company. Division A of a large organization manufactures a single standard product. Some of the output is sold externally, whilst the remainder is sold to Division B. In Division B, it is a sub-assembly in a manufacture of that division's product. The unit cost of Division A's products are as follows. Material cost is 4 per unit, direct labor 2, direct expenses 2, variable cost 2, and fixed manufacturing expenses 4. Selling and packing expenses amount to 1. That gives a total unit cost of rupees 15 for this Division A's product. Now we are going to look at an example where we are going to add a further complexity. We are going to add a fact that you have a company with 2 divisions. The company is selling from A to B, but it is also selling outside. So it is selling some product to B and it is selling some product to the outside market. We have seen that the total cost on a full cost basis is rupees 15 per unit. That includes the fixed overheads as well as the selling and packing expense. We have mentioned before that selling and packing expense is not incurred when the company is selling within its own divisions. And secondly, the fixed cost that has been included must have had some estimation as to capacity and volume, a projected volume at the beginning of the year to arrive at the per unit fixed cost of overhead. Annually, 10,000 units of the product are sold externally at the standard price of rupees 30. In addition to external sales, 5,000 are transferred annually to Division B at an internal transfer charge of rupees 29 per unit. This transfer price is obtained by deducting variable selling and packing expense from the external price. Division B incorporates the transferred in goods into a more advanced product. There are 10,000 units being sold externally, and from A to B, 5,000 units are being sold. The 5,000 that are sold are transferred at a price of rupees 29. The outside selling price is rupees 30. The way this transfer price has been set is that they have taken the market price, one that is being used for external customers, of rupees 30, and they have deducted 1 rupee per unit, which is the cost of selling and packing. And we have mentioned before that selling and packing is not incurred when divisions are selling to each other. So 5,000 is being sold to Division B at a transfer price of 29 and 10,000 outside at a price of rupees 30. Division B incorporates the transferred in goods into a more advanced product. The way this operation, we said, is being conducted is that Division A is producing a product which is transferred to Division B, sold to Division B. Division B uses this as a component and it develops this and produces a more advanced product and sells to the market. The unit cost of this product are as follows. Transferred in item from Division A, this is the transfer price of rupees 29. Direct material and components, the unit costs of this product are as follows. Transferred in item from Division A, rupees 29. Direct material and components cost 23, direct labor 3, variable overheads 12, fixed overheads 12, and selling and packing expense 1. This gives a total cost of rupees 80. The total cost of rupees 80 per unit, it includes the fixed overheads, the variable overheads, its own variable cost of material and labor, plus it includes the transfer in cost, which is the transfer price from division A of rupees 29. So that is giving you the total of rupees 80 as the cost of the unit and product that is developed and sold to the outside market. Division A produces the product and the transfer price is rupees 29. Don't forget, the price that has been arrived at, the transfer price, is the market price of rupees 30 less the selling and packing expense of rupee 1. Now that 29 has been incorporated into the cost of rupees 80 for the final product. Division B's manager disagrees with the basis used to set the transfer price. He argues that the transfers should be made at variable cost plus an agreed minimal markup. He claims that his division is taking output that division A would be unable to sell at the price of rupees 30. Partly because of this disagreement, a study of the relationship between selling price and demand has recently been made by the sales director. The resulting report contains information that we are just going to share with you. The perspective now is being shared from Division B, where the Division B's manager is claiming that the price being used, which is rupees 30 minus the selling expense of 1, which is rupees 29, the manager claims that this is an inappropriate price. He says that it is leading to different and incorrect decisions, and the optimality of the company as a whole is not being achieved. He has claimed that Division A would not be able to sell this quantity to the outside market at the price of rupees 30. So therefore, it is not appropriate to charge that price to Division B. Now, because this dispute has arisen, the company therefore conducts a survey. And the survey is regarding the quantities to be sold at different prices. And let's see what the survey then indicates. The survey shows for Division A, at the three selling prices of rupees 20, 30 and 40, the demand is 15,000, 10,000 and 5,000 units respectively. For Division B, at the selling prices of 80, 90 and 100, the demand respectively is 7,200, 5,000 and 2,800 units. The manager of Division B claims that the study supports his case. He suggests that a price of rupees 12 would give Division A a reasonable contribution to its fixed overheads while allowing Division B to earn a reasonable profit. When the company conducted the survey to try to find out what would be the demand at the different selling prices, we have seen for Division A and for Division B the different demands at the different selling prices. For Division A, we have seen the prices of 20, 30 and 40. And for Division B, we have seen the prices of 80, 90 and 100 and the related demand. The manager of Division B says the demand shows what he was trying to say, and it reflects and supports his case. That at the price of rupees 30, the demand for product A is 10,000. So, if 5,000 is being purchased by Division B, the 10,000 that is currently being sold to the market outside, the Division A would not be able to continue and have the same sale at this price. And so he has suggested that a different transfer price be used. Instead of using 29 rupees, he has suggested to use the price of rupees 12 as a transfer price. We can just quickly go back to our previous slide and see the cost, where the cost per unit of division A was rupees 15, and we will find that he has eliminated the selling expense and the fixed cost. So if you remove the fixed costs, then that is the price that he is suggesting to use as the transfer price. He is saying that at that price, the division will be able to cover its costs, and he is saying that division B will be able to provide a reasonable profit at that price. He also believes that it would lead to an increase in output and an improvement in the overall company profits. Transfer pricing, we have said, is going to impact overall company profits. And the policy that is used is going to impact both the division as well as the company as a whole. Here, the transfer price that was earlier being used was that of the market price, less the 1 rupee for selling expenses. Now, this is a big change. What is proposed is rupees 12. Rupees 12 has been proposed as the transfer price. Let's quickly look back at the cost of division A. The total cost of division A was rupees 15, and rupees 15 included the direct materials, direct labor, direct expenses cost, variable expense of 2, and fixed manufacturing expense of 4, and selling and packing expense of 1. So the total cost was rupees 15. The total cost we have seen is rupees 15, as the manager of division B is suggesting a price of rupees 12. And according to him, this price of rupees 12 is going to cover the fixed costs of division A, and it is going to provide a profit to division B. Required: A, to calculate the effect of the transfer pricing system has had on the company's profits, and B, to establish the likely effect on profits of a transfer price of rupees 12 as suggested by the division manager. So this is what we are required to do now. As we have done in an earlier example, a simpler example, we have to see what the impact of this transfer price is on the entire company, and what will happen if the transfer price as suggested was reduced from 29 to 12. Let's look at the workings to see, first of all, the impact on the company of this current transfer price. The variable cost per unit of output for sales outside the company are rupees 11 for the intermediate product and rupees 49, that is 10 for A and 39 for B, for the final product. Selling and packing expenses are not incurred for internal transfers. Optimal output of intermediate product for sale on external market, we saw the selling price when it is 20, the contribution would be 9 because 11 is the variable cost, and it would go up to 19 at a price of 30 and 29 at a price of 40. The demand, we were told, was 15,000, 10,000, and 5,000, hence total contribution would be 135,000 at price of 20, 190,000 price of 30, and 145,000 at a price of rupees 40. Optimal output is 10,000 units at a selling price of rupees 30. The working and the calculation is going to be based on what would be the contribution to the company. We have seen that the variable cost for division A was rupees 11, where the total cost was rupees 15. If you remove the fixed cost and the selling cost, then the variable cost is rupees 11. So the variable cost is 11. When the selling price is 20, the contribution would be 9. Selling price is increased to 30, the contribution increases to 19, and so 29 at the selling price of 40. Calculating the demand that was given in the study, and then by using that demand figure, we find that the maximum contribution is obtained at a price of rupees 30, where the demand is 10,000. Optimal output for the final product. Selling prices of 80, 90, and 100. Here, the contribution is 31, 41, and 51. The variable cost of this product we saw earlier is rupees 49. So giving a contribution of 31 at a price of 80, and 41 at 90, and 51 at 100. The demand in units we were given as 7,200, 5,000, and 2,800. This gives total contribution of 23,200, 205,000, and 142,800. Optimal output is 7,200 units at a selling price of rupees 80. Optimal output of division B based on transfer price of rupees 29. So this working demonstrates that the optimal price is over here. For division B, price is 80, and it can maximize its contribution at a price of 80, and the maximum contribution would be 232,000. Division B will regard transfer price as variable cost. Therefore, total variable cost will be 68, which is 29 of transfer price and 39 of its own cost. And division B will calculate contribution as follows. Selling price of 80, contribution is 12, which is 80 minus 68, and the demand is 7,200, so the total contribution is 86,400. As the selling price increases to 90, unit contribution is 22, demand is 5,000, and total contribution is 110,000. And at a price of 100, the total contribution is 89,600. The management of division B will choose output level of 5,000 units at a selling price of rupees 90. This is suboptimal for the company as a whole. So if the company uses this 29 price, then it is going to choose 90 as the price which is going to give it the maximum contribution, and that would be suboptimal for the company. Profits for the company as a whole are reduced from 223 to 205 at 5,000 units. The 205,000 profit would be allocated as follows. Division A, 95,000, which is the 5,000 at 29 minus 10, and division B, 110,000. So we can see that by using the transfer price as it is doing at present, the company would reduce its total profits and total contributions. Therefore, it is suboptimal for the company to continue with this transfer price, and it has to re-examine and look at a transfer price that would be optimal for the company as a whole and not for one division only. That's all for today. Thank you very much.